So, how do you value a company that has no profits, no history, and a terrifyingly high chance of failing? It sounds impossible, doesn't it? You can't just project last year numbers because for a lot of startups, there are no real numbers to project. They are often just an idea, burning through cash with a mountain of uncertainty ahead. This is the exact problem that stumps even the smartest investors and founders. The traditional valuation methods you learn in finance class, they completely fall apart. But what if I told you there's a better way? The finance world's dean of valuation, Aswath Damodaran, a professor at NYU, has a genius framework that actually cuts through all that chaos. And today, I'm going to show you exactly how his framework moves beyond simplistic formulas and embrace the wide reality of valuing a new business. The problem: why the old rules don't work. Let's be real about why this is such a monster of challenge. Valuing a young company throws at least six huge wrenches in the works. First, there's no history. You might have a year or two of data, maybe, which is nowhere near enough to build a forecast you can trust. Second, they are almost always losing money, so you can forget about metrics like a PE ratio. Third, they run on private capital, not public markets, so their financial data is way less transparent. Fourth, you have different investors with different share class, all with unique rights, which makes figuring out the value of any one share a nightmare. Fifth, the shares are illiquid. You can just dump them on the stock market tomorrow. And finally, the biggest, most intimidating factor, the massive chance of failure. Depending on the study you read, a huge percentage of startups simply don't survive. So, when you try to jam the numbers from a young, cash-burning startup into a standard discounted cash flow or DCF model, you get garbage. That model wasn't built for this. It's like trying to navigate New York City with a map of London. It's not just useless, it's actively misleading. The big idea, a myriad of story and numbers. This is where Professor Damodaran's philosophy changed the game. He argues that a good valuation isn't just a spreadsheet, it's a marriage between a story and a numbers. A story without numbers is a fairy tale, but numbers without a story? That's just a meaningless black box exercise. Think about it. For a major company like Coca-Cola, the story is pretty much written. The numbers are just the next chapter in a very long book. But for a young company, the story is everything. The valuation process has to start by crafting a narrative. What is this business? What market is it trying to conquer? What its competitive edge, its moat? How is it going to turn that grand vision into actual revenue and one day profit? The story then becomes the bedrock of your financial model. The modern approach forces you to connect every single number back to a piece of that story. If you are projecting insane revenue growth, your story better explain how. Is it by stealing a huge slice of a growing market? Is it a revolutionary new technology? This bridge between the narrative and the numbers is the war key. It makes the storytellers get real about the numbers, and it makes the number crunchers use their imagination. The how-to, the six inputs that actually matter. So if we're not using our data, what do we focus on? The modern says to stop obsessing over dozens of tiny details and instead nail down six essential inputs. The three are about the business itself, and three are about the risk. Let's start with the business model. First up is revenue growth. This is your top line story. How big is the total market? And what chunk of it can this company realistically grab over time? The story you tell about the market and the company unique advantage directly fits this number. Second is the target operating margin. This is all about long-term profitability. Sure, the company is losing money now, but the whole valuation hangs on the belief that it will eventually make money. What will its profit margins look like when it's all grown up? You can look at public companies in the same industry to get a ballpark idea, but your story has to justify why your company will get there. Third is the sales to invested capital ratio. This is a super important, often ignored metric that measures how efficient the company is. It answers the question, for every dollar we put back into the business, how many dollars of sales does it spit out? A company that can grow without constantly needing huge cash infusions is way more valuable than one that has to spend a ton for every new customer. Now, for the three risk factors. The next two are the cost of equity and cost of debt, which give you the overall cost of capital or the discount rate. And this is where the Damodaran really flips the script. He says analysts waste way too much time trying to calculate a perfect discount rate for one super risky startup. Instead, he just looks at the distribution of the cost of capital for thousands of public companies and use percentiles. He might use the 90th percentile for a high risk scenario and a 10th for a low risk one. This gives you a range of possibilities, not a single falsely precise number. The final, and maybe the most crucial risk factor, is the probability of failure. A standard DCF model just assumes the company will be around forever, a going concern. We know that's just not true for most startups. The model says you have to deal with this truncation risk head on. It's simple but profound idea. Take your beautifully crafted valuation and multiply it by the probability of survival. Is there's a 30% chance the company dies, there's a 70% chance it lives. Your final number has to reflect that cold, hard reality. By the way, if you are getting value out of this breakdown of a pretty complex topic, do me a favor and hit that like button and subscribe. We go deep on ideas like this every week, and it's the best way to support the channel and make sure you don't miss what's next. Embracing uncertainty with distribution. A huge theme in the modern work is that we have to accept uncertainty, not pretend it doesn't exist. He says the biggest challenge in valuation isn't about building a fancier model, it's about dealing with what you don't know. My favorite quote of his is, you don't have to be right to make money, you just have to be less wrong than everybody else. So, how do we do that? We stop using single point estimates and start using probability distributions. Instead of saying the target margin will be exactly 15%, you define a range. You might say, look, I think there's a good chance it ends up between 12% and 80%, but my best guess is 50%. You do this for all your key inputs, growth, margin, efficiency, the works. Then you fire up the Monte Carlo simulation. This is basically a computer model that runs your valuation thousands of times. In each run, it picks a random value for each input from the range you set. One simulation might get high growth and high margins, the next might get low growth and low margins. The result isn't one number, it's a full distribution of possible values for the company. This doesn't just tell you what the company could be worth, it shows you the probability of it hitting all those different values. It turns valuation from a hunt for a single right answer into a sophisticated game of probabilities. This whole approach admits that the future is fuzzy and gives you a much richer, more honest picture of what might happen. What about the venture capital method? Now, this rigorous story-driven approach is the polar opposite of the common venture capital method. A lot of VCs just work backward. They decide on an exit value they want in 5 and to 10 per years. and then apply some arbitrary target rate of return, like 50% or 70%, to figure out what they should pay today. Damodaran argues this is basically an illusion. Those target rates match operating risk and failure risk together with no real logic, making them a balloon instrument. He slams this as an act of pricing, not valuation. Pricing is about what other people are paying for similar things right now, driven by market hype and momentum. Valuation is about a company's fundamental ability to generate cash. The VC method is a pricing game. It might work for them, but it doesn't tell you what the business is actually intrinsically worth. So, what's the big takeaway? Aswath Damodaran's framework isn't a magic formula. It's a total shift in mindset. First, you have to connect a believable story to discipline numbers. The story gives the number meanings, and the numbers keep the story honest. Second, you have to give up on false precision. Instead, you focus on the handful of big drivers that truly matter: growth, margins, efficiency, the cost of capital, and most importantly, the chance of outright failure. Third, you embrace the unknown. You use range and simulations to map out the entire spectrum of possible futures, not just one. And finally, you must separate the risk of your business not working out from the risk of it just going broke. A company can have a great idea, but still fail because it runs out of money. And your valuation has to account for that. Valuing a young company is one of the toughest things to do in finance. But with this framework, it's no longer impossible. It becomes a structured way of thinking, of telling stories, and of managing uncertainty. It's a tool that lets you look at the most chaotic, unpredictable business in the world and find a plausible path to what they are really worth. And in a world fueled by startups, that's a superpower.